Well, thanks, George. As always, it's a pleasure to be working with you and your group, especially. Today, we wanted to touch a little bit more on Madison Insurance Group, who we are and what we are. Um, for those of you who don't know, I'm Mark Sims. I'm president of Madison Insurance Group. We have been in business for 26 years, and I've been with the company all 26 years. President just means I can delegate work. I like staying on this side of the aisle of new business and development. But met George, and we thought there's a lot of synergies behind what George does for you as advisors and for your clients with regarding to well, the main thing is to help with that predictable, sustainable cash flow. What Madison does and what Madison offers is how to protect the business from that interruption of that's cash flow through events that's outside of their control. Madison Insurance Group is we own and we operate a couple of insurance program companies of which are based in Puerto Rico. That the picture you see there on your screen, that is not George's backyard. Although he probably would like to have a backyard like that. That is old San Juan, Puerto Rico, and we our insurance structure that is going to help you with your clients with business interruption or cash flow interruption. These insurance companies are domiciled in Puerto Rico. And why are we doing business in Puerto Rico? We're not the only ones that have figured out the benefits of Puerto Rico. The benefits of Puerto Rico are both a territory of the United States. All U.S. federal laws apply in Puerto Rico that apply here in the mainland, but they're a tax benefit or a tax haven for U.S. businesses. So the Puerto Rican government is not taxed by the Internal Revenue Service. The Internal Revenue Service does not have tax and authority there. They have their own tax and authority called the Puerto Rican Hacienda, right? Pretty cool name for a taxing agency. But we're there because of the longstanding relationship with the laws and regulations in the United States, but not taxed as a United States territory. We have two insurance companies. We have a licensed insurance carrier, and that insurance carrier allows businesses to insure what we call is enterprise risk. Think of these risks that a business have that could interrupt their revenue, which would interrupt their business. I mean, some of these can be financially catastrophic. Uh, these are types of risks that keep business awake at night. We're not talking about insuring commercial auto or commercial property, or workers' compensation, things like that. These are risks that, if they happen outside the control of the business owner, that would interrupt their cash flow. Now, the difference with buying these insurance products or these insurance policies from Madison is we are going to take an insurance expense that the business gets to tax deduct and create. Not only are we going to give them coverages of these risks that keep them awake at night, but we're also going to turn that risk into a potential asset for the business owner. So here's the benefits to the client, to your clients, if they participate in the Madison program. They're going to protect against risks that interrupt their revenue. If they have a claim, 50% of their claim is going to come out of paid by the reinsurance pooled account. The other 50% is going to come in from their participation in this program, which we're going to talk about a little bit more in detail here. But it becomes a planning tool for the business owner. We're going to take this liability that they have in their business, and we're going to turn it into a potential asset in a segregated account for them. We're going to take the premiums that they pay. They're going to be tax deductible, 100% tax deductible from the business as a necessary business expense under Code Section 162. But instead of those premium dollars going to the insurance company's black hole, they're going to flow into a separate account. And that is where their underwriting profits will flow. Underwriting profits will be all the premiums that they pay, less the expenses that the insurance carrier drags on that premium amount. And that underwriting profit is going to get invested and it's going to earn investment income. So think about how insurance companies make money. They collect your premiums, right? What do they do with those premium dollars? They allocate so much to their overhead costs. They allocate so much to claims, and whatever they keep is their underwriting profit, and they invest it. But they keep that underwriting profit investment income for themselves. In the Madison program, we allow the owner of the business to recapture all that underwriting profit investment income earned on their premium dollars if they have little or no claims, and that would come back to them at worst case scenario as a long-term capital gains tax rate, but there's ways to even avoid that, which we'll talk about here shortly. So we're putting in asset protection as well. The assets in these segregated accounts are asset protected from any creditors that they have, also protected from our insurance company's creditors just through proper restructuring. So what are some of these coverages that our clients are buying? In the Madison program, we have the ability to write over 80 different combinations of insurable risk that would interrupt a business's revenue. How we know what of these 80 different combinations of policies that they can write, so we take them through an underwriting process. We gather data from the business, all right? These are what you're seeing on the screen here are the top 10 coverages that we offer to our clients, right? And you can look at these: loss of a key talent or key person. Don't confuse this with keyman insurance, right? Keyman insurance is usually funded with a life insurance policy, and somebody's got to die in order to get that benefit. This policy that Madison offers for businesses, if you have key people in your organization and you lose key people or a key person outside of your control, you can't fire them, right? But if you lose that key person and the loss of that key person they could go to the competitor down the road, cause the business to lose revenue. Right? Loss of a key customer, loss of a key contract. Talked to a client the other day. Amazon was 75% of their revenue. If they lost Amazon, that would be financially catastrophic. Reputational brand. Somebody gets hit with a bad hit for their reputation, and that bad reputational hit caused them to lose revenue. We can reimburse. That could be a reimbursable claim. Cyber, right? Everybody's scared of cyber, especially with the onslaught of AI, right? Most commercial cyber policies don't cover ransomware. The Madison program is a broad-based coverage, right? Loss of a key supplier. These are the types of risk that will reimburse. Now, what do we reimburse on these policies? We don't reimburse the gross revenue loss. We reimburse the net income loss from that revenue. Some of our policies are direct reimbursement policies. Business gets sued. They got to go to court. We know the most expensive part about a lawsuit is the cost to defend. Those costs can be reimbursed. So we gather data through the underwriting process, and our goal is to come back to the business owner and say, based off the data we collected, here's all the policies you can buy from Madison. Here's the different policy limits you can purchase on those policies, and here's a premium for each one. So we allow the business to go pick and choose coverages and limits and premiums based upon their budget and how much they want to pay. These are 12-month claims-made policies. So we go through this renewal process. Now, up to this point, we talked about you buy the policies, that's a deductible expense. But what happens after that? If you are a business owner and you mitigate your loss, have little or no claims, all that underwriting profit investment income earned on that, we can send it back to the business owner when they no longer need the coverages or any of the surplus on it, or to some structure that's in the same economic family as the business owner. So how does that work, right? How does a business get to transfer all of these liabilities of these policies to a third-party insurance carrier, but yet be rewarded for their good risk management with little or no claims? Well, as I mentioned, there's two insurance companies in this program, all right? Both of these insurance companies, Madison International is a licensed P&C company, and Madison Re is a licensed reinsurance company, are domiciled and regulated in Puerto Rico, and we're there because of the statutes and laws that allow a business to participate in their own good risk through the underwriting profit and investment income accumulated on their premiums that did not go towards claims. So right away, when we do an underwriting process, the business picks those coverages and their premiums, they're going to pay those premiums to Madison International. Madison International is the insurance carrier that's going to issue the policies as if they bought them from State Farm, Liberty Mutual, Progressive, whoever. Same thing. There's your tax deductible expense as a business owner. Madison International issues the policies. Madison International binds the risk for coverage. But Madison International then is going to take all of those premiums they collect from their insureds and all the risk of claims, and they're going to seed it down to Madison Re, a licensed reinsurance company. If you don't know anything about reinsurance companies, they're insurance companies for insurance companies. No insurance company takes on 100% of exposures. All right. They all cede off some premium and risk that they collect from their insureds. Madison Re is no different than Lloyd's of London or Swiss Re or Gen Re. Madison Re is going to absorb all the risk of claims and all the premiums from Madison International. Madison Re is where the business itself and the owner of the business get to participate in the underwriting profits, investment income of their own good risk. Madison Re is organized as what's called a protected cell reinsurance company. Madison Re has inside of it 2,000 of what are called these segregated asset plans or segregated accounts. These segregated accounts, what are they? Think of them as funding accounts. Madison Re is going to link back the premiums and the policies that insured business buys into one of those separate accounts. And it's in that separate account where the underwriting profits flow from the insured business premiums. Now, what happens to that money? What's the underwriting profit in the Madison program? It's all the premiums they pay, less the annual fees that Madison International charges, less the annual fees that Madison Re charges. The rest of that money goes into that segregated account and gets invested and earns investment income at a tax-deferred or a very, very low tax friction rate because it's being taxed by Puerto Rico's tax authority, which allows that to grow tax-deferred or a very low tax friction rate of 4%. Now, that segregated account is owned by and controlled by Madison Re to the extent of what? If the business has a claim, their own claim, and it gets approved as a valid and binding claim, Madison Re has to send the funds to Madison International to pay that business's claims. How those claims are paid is 50% of that claim comes out of that segregated account. The other 50% comes out of Madison Re's pool. We've been doing this for 26 years. What is Madison International's loss ratio of claims? Madison International takes in over $150 million of premium every year. About 1 to 2% of that goes out to paid claims. Why are they so low? Because we deny all claims? No. Madison International's policies are low probability by nature. Number two, we have great underwriters, right? We got to protect Madison Re's pool just like any insurance company. We're not going to buy risk. We take on good risk. Number three, why they're so low, is the most exciting part about this presentation. That underwriting profit investment income that flows into that account, Madison Re legally holds on to it. But when the insured business no longer needs coverages for risk, all that underwriting profit investment income gets returned back to the owner of the business or to some structure or some entity or some vehicle in the same economic family as the business owner. And we'll get into that. So let's talk about the tax benefits of this program. As I mentioned, the first tax benefit is the premiums that the business pays are 100% tax deductible because Congress allows businesses to tax deduct insurance premiums when they're buying insurance from a bona fide insurance structure for U.S. federal tax purposes. So, what is the maximum premium that somebody can pay for these coverages? Well, I'll give the answer I always get when I ask my attorney a question. It depends. It depends on what can actuarially be determined on the premium of the policies that the business has that we identified that they can buy through the Madison program. All right. Historically, I'm not an actuary. We have the actuarial pricing done by outside independent actuaries. Typically, we see on a max end premiums that the max can be paid in a program like this is anywhere between 5 to 12% of their gross revenues. Gross revenues. So we have premium payers that pay $100,000 a year. We have premium payers that pay $9, $10, $15 million a year, all of which is fully tax deductible. The assets in the segregated account, I told you, the underwriting profit investment income that flow into that account that's linked back to the policies and premiums of the insured, those are taxed by the internal, by not the Internal Revenue Service. They're taxed by the Puerto Rican Hacienda Taxing Authority. How is that taxed? The Puerto Rican Hacienda looks inside that separate account at its net profit. The net profit is determined by an annual formula. It starts with that annual premium that they paid, less the expenses that the insurance carrier, Madison International and Madison Redrag, less any claims that the insured had. If they had any claims, then 50% of that claim had to be dragged out of that account. That would be deducted off that formula, plus the investment income earned. All that formula, so it's premium, less expenses, less claims, plus the investment income earned on the assets for that year. That's the net profit of that account. The first 1.2 million of that is not taxed. It's tax exempt. Any amount above that pays a tax of 4% on the difference. So there's the underwriting profit investment income growing in a very tax efficient way. If the holder of the rights to that money is the owner of the business and he's a U.S. resident, taxed as a U.S. resident, and he exercises the money to take the money out, that's returned as a long-term capital tax at long-term capital gains tax rate. So here's the arbitrage in worst case scenario. You got a tax deductible expense. If it's a pass-through entity, that's reducing their personal tax rates. It's going to grow tax deferred or a very low tax friction rate. Worst case scenario, it comes out at long-term capital gains. But there are ways in this program to mitigate against that. You could even eliminate capital gains tax on that, depending on what the exit opportunities are for the holder of the rights to that money in that account. So if there's no structuring, obviously long-term capital gains tax rates. But over the years, I've seen all these types of structuring that you guys do. You advisors do this for your clients. You work in the M&A world. You're always talking about exit planning. What are some ways that they can hold the assets in that segregated account, the owner of the business, to get it out at a better tax rate? Trusts, any kind of trust, generational skipping, legacy, dynasty, charitable remainder. There's these slats trusts out there. They're pretty phenomenal. They can actually have the holder of the rights to that money in that segregated account be a qualified retirement plan, an IRA, or a Roth IRA. So if you think about that, you tax deduct the money as a premium going in, the business is getting the coverages, money flows to the segregated account. The holder of the rights to that money in that segregated account could be a Roth, which means that Roth exercises its rights, takes the money out, goes into the Roth, and gets distributed out of the Roth tax-free. Profit sharing plans. You can use the segregated account for employees or key people in the business. They can hold the rights and they can have their own separate account, and some of the premium dollars go in there. You can use it, a business owner can use it as a golden handcuff to retain quality employees or quality executives. There's this structure that some of you know about. Some of you are probably experts on these private placement life insurance policies. I don't know a lot about these. To me, looking at these things, they're a Roth on steroids with a death benefit, but we are seeing an uptick of holders of the rights to that money in that segregated account via PLI and obviously other charitable structures. Who are the ideal clients for this program? Any business with $2 million of gross revenues. Gross revenues. The economics for the business owner get better with size. The bigger the premiums that come in, the lower those annual fees that the insurance carrier drags on the annual premiums. This is the targeted market. Who's a good targeted market for your clients. These are our top 6 or 7 industries that make sense for a business to participate in the Madison program. Now, here's the good news. This program and the types of policy we write is not industry specific, right? All businesses that have revenue, that are producing revenue, have some sort of enterprise or business interruption risk. As I mentioned early on, we have 80 different types of combinations of policies in this program. Which ones are best for the client, we'll find in the underwriting process The underwriting process is there's an application or risk assessment questionnaire. We look at their business's financials. You send that data to us. We have in-house underwriters that will determine which policies make the most sense, and then we send it out to independent actuaries for them to price those policies. Um, I don't understand actuarial science. It's black magic to me, but it works. All insurance companies determine their risk profiles and their premiums with independent actuarial firms. So, what is the Madison program and how can it benefit you and your clients? First, in my opinion, it's a total risk mitigation program. First and foremost, the business is going to mitigate against those low probability, high severity risks. Again, these are risks that keep business owners awake. And I was on a call this morning with a huge electric company in Atlanta, Georgia. And the owner of the business saying, I keep losing my top talent to recruiters. They leave to go down the road. Well, you can insure against that. If you lose that talent because they leave you outside of your control, you can insure against the loss of net income from that revenue. But better yet, you can make them a holder of one of these segregated accounts where these premiums are flowing to as a golden handcuff. So first and foremost, we're mitigating against these low probability, high severity risks. There's tax mitigation, right? You got a tax deductible expense, 100% to the business. And all these businesses are pass-throughs, right? So they reduce their personal taxes. Um, the assets that are growing inside the segregated account are growing at a very, very favorable tax rate. First 1.2 million net income, tax-free. Any amount above that, tax at 4%. All right. So you got tax benefits. Worst case scenario, that money comes out to the owner of the business at a long-term capital gains tax rate. But as we looked and saw, there are options. How do we avoid the long-term capital gains? So you've got tax mitigation. You got wealth accumulation opportunities, create another profit center for the owner of the business. You have wealth transfer opportunities. I can get it to the kids, the next generation, or skip a generation, or I can get it in some kind of a structure or program that is not taxed. If you think about our government and taxes, they allow you to tax deduct, or they allow you to let it grow tax free, or they let it come out tax free. Very rarely do they let you do all three. In the Madison program, in combination with what you can do on the exit planning strategy of the holder of the rights to the money in that segregated account, you could get all three tax benefits: deduction, deferral, tax-free. I had a tax attorney one time told me that's what they call the golden tax monkey. And he'd been saying it for 2 or 3 years. I finally said, what do you mean when you say the golden tax monkey? He said, have you ever seen a golden monkey? I said, no. He said, that's how rare it is to get a deduction, a deferral, and a tax-free if you do proper planning on the back end, which is what you guys do. Our job at Madison Insurance Group is to provide the insurance product, to provide this insurance structure, that the only difference between us and a standardized commercial insurance carrier is that underwriting profit investment income can be returned back and reward the business with good risk management procedures and protocols that have little or no claims. All right. I know that was a lot. I want to stop there, George. I wanted to offer some questions because I know a lot of people have questions on these things. I'm more than happy to go back in details on some more of the structuring or those kind of things if they like. But
Yeah, there's one thing I want to underscore for the wealth advisors who are hearing this message. Listen, I'm excited about Madison. So, Mark, you know where I'm going. Go
I
ahead.
do. I've failed to mention it. Go ahead. You want me to?
Gue-
You want me to say
Guess
it?
who get? Well, no, you go ahead. You'll do a better job than me.
All right. So as we go back to this, I think this is what you're referring to, but you can correct me if I'm wrong.
Exactly right.
The money that flows into that segregated account, the premiums that flow into that, the underwriting profit that flows in there, legally and technically is invested by Madison Re. However, We don't employ investment experts. We allow outside investment advisors and firms manage those assets in that account according to an investment policy guideline. So what Madison also does in this program for those of you who manage assets is we create AUM for you to manage. And every year it's new AUM. Why? Because the business is paying premiums, right? Oh, by the way, they get to tax deduct that as well. You can become a hero to them that you're taking this expense that they're deducting and create an asset that you get to manage. So we have right now we have I think that's what you wanted to mention, right, George? Yeah.
100%.
Okay. Yeah. So we have a big portion of our referral sources that bring us business are investment firms. And to that point, 12 years ago, we were fortunate to have Morgan Stanley come in and say, we heard about your program, but before we were going to allow the Morgan Stanley financial advisors to promote this and invest money in that, we want to make sure you're legit. So we went through an 18-month vetting process with Morgan Stanley corporate out of New York, and they promote the Madison program to their 16,000 advisors. But we have 18 other different investment firms that are in the Madison Re program now. We're agnostic, all right? But as long as they set the account up and properly, we don't care which investment firm does it.
Well, and what I think is powerful, just as an underscore, is that these very sophisticated players like Morgan, like Ray J, etc., you are on their platform. And ladies and gentlemen, that is they are, the Madison program is vetted, and from my perspective is I mean we know it's not my perspective, absolutely unique. And if we imagine as advisors the decisions our clients make to hide cash, right, to bleed off cash so that they don't have to pay it as tax, does this not make a certain amount of sense um, for our clients, especially clients that are generating a ton of cash out of their business? And my argument is yes. Since we are in the wealth and legacy creation business, all of us, right? All of us, we're an integrated matrix. That's why I'm so excited and I'm beating the drum so loud and long for Madison.
Well, and the thing that I like about your organization, George, is your main theme. And I think what I've learned is you're helping businesses protect or plan
Yeah,
for sustainable, predictable cash flow, right?
correct.
Well, the one thing that we can't plan for properly is things outside control, right?
Yes.
COVID, right? COVID was a time when people had business interruption, right? Um, and so I think that's why the Madison program dovetails to what you're doing. Not only are you going to help them grow the company, right, and hopefully sell the company, but if any oops happens along the way, you can insure it in the Madison program. And if they manage the risk and don't have the oops, then all that premium they paid is not a sunk cost.
Well, and it's fascinating because there's a lot we're gaining the concept of an 85 plus strategic capacity asset business, right? These best in class businesses is gaining a lot of traction. And when we think about those businesses and a business owner who may never want to exit, do we not want to be plowing cash into a very tax efficient, appreciating account? And that this goes to. I mean, you and I are in lockstep, Mark. This is why we get along. Hey, I'm going to open it up. Does anyone on the call have questions for Mark about the program? Don't be shy.
Do they ask them verbally? They type it in.
Um, they can do either. If you raise your hand, I will allow you to talk. In fact, I can click. Kids, I'm just gonna allow everyone to talk. Uh, even John and John. Jemiah, great to see you. Ed is incredibly knowledgeable. Barry, um, and
I will also
what?
allow John and Carter if I missed anything that you thought maybe needed to be presented. I don't know how I missed the AUM, George. I'm glad you caught that.
Didn't happen.
Mark, maybe you can address the minimums and the maximums. We don't have a maximum for premiums amount.
Yeah. So, what makes the most sense economic in the Madison program as far as premium levels? The minimum premium level to get into the program is $100,000. So you're going to need a business whose gross revenues are probably $2 million to get to that level. There
Sure.
is no maximum, only what the underwriters and the actuaries can identify. As I mentioned earlier, there's a broad range of premium payers in the Madison program. Of the 150 over 150 million we collect every year in premiums, it's all across the board.
Yeah.
I think our highest premium payer is about 14 million. Um, but yes.
Yeah. Hey, Garrison, I see you have you're unmuted. And I got your note via text. Go ahead.
Yep.
Mike, you still there?
Which note?
Is this something I could share?
I was talking about the recording
Yeah,
because I was
100%.
very fortunate to sponge off of these generous people while we were in Charleston at that dinner.
Yep.
So very familiar. I guess this is like I know John and I are dialoguing back and forth, and we're going to see each other down in Nashville. So looking forward to that, John. And thanks for being so great at follow up. But like I guess the biggest thing that I have is not a concern at all about your guys' ability to function, but it's the complexity of the landscape for the advisors that I'm working with,
Mhm.
that figuring out a very simple multi-step introduction process for you guys so that I don't expend my own capital with them, my own relationship capital, and have it not go somewhere.
Right.
So that's kind of what I'm looking at is how do we penetrate some of these shops where we've still got a centralized owner dealing with the complexities of managing an independent shop, get you guys in there effectively without it being like, hey, let's do an hour-long call.
Welcome to our daily world.
Right.
um, uh, so John Bloom, you got your hand up. Did you
No,
want to address that, or
please
you want me?
answer this first. It
Okay.
was different.
Okay, you have it just okay. Um, yeah, so we don't expect it's a sophisticated product, no doubt. But we don't expect you to go in with all the details initially. We've created some marketing material. We're actually going to be coming out with some new stuff this year. We're going to make our website more interactive for the layman person to go in there and try to figure out what this is. We have a 3-minute video that explains the program. Be more than happy to get you that information.
I'll
Uh,
post a 3-minute video in our community.
okay,
If
yeah,
it's not already
that's
there.
usually a
Yeah.
good start, Mike. Um, we have other, we have a one-page handout that says explains what this is and what this can be to the owner of the business. And we can get as granular as you want with our market material. But
Hey, Mark,
I don't,
let me ask you a better question. Thank
yeah,
you. Let me ask you a better question.
okay,
So how because I have no doubt about the efficacy of this once we get you guys in.
yeah.
But the people that know me because of my books and other stuff like that are going to want more about, okay, well, if I say yes, how long does it take for I'm up and running? How complex is it once it's up and running?
Um, Once we take a client through underwriting, that means we've got their data. We submit a proposal. From the time they pick the coverages that they want and the premiums, we can have them up and running within a matter of a week or two. Okay.
Nice.
So we mo- and most of the business doesn't come in until towards the end of the year, right?
Yeah.
How much
There's a reason for that, right? Because
how much
most people,
load is on the advisor side? Mark,
what's that?
how much load does the advisor side have as far as any paperwork processing, stuff like that?
You don't do any paperwork.
Beautiful.
So when we get to the client and they're ready to do the underwriting, we have a whole onboarding system of how we do that. The hardest part in the program with onboarding is getting the client to get us the data. All right. They're where we might do some hand-holding, but we can handhold with them. They can how many people get to talk to their underwriters from their insurance company, right? Our
Yeah.
underwriters will get on the phone with them and walk them through, the application process, make sure we get all the information accurately. So, that's the hardest part, right? And it's really not that hard if we can get them on the phone with our underwriter.
Hey, Mark, if I
Yeah.
may, a good probably multi-step process for this is you got to get their interest from kind of a general standpoint. What does this mean? It's a way to redirect taxable revenues in a capital and tax efficient manner that can come back to you. And you're really just selling that initial call where we can then really drill down on what it means, how do the mechanics work, and then the sale, if you will, on that first call is let's take you through underwriting. There's no cost to that. It is a little bit of a time requirement, and probably call it 45 minutes to an hour for the business owner to complete the information. The more complete, the better. And then from there, we can really review what it really looks like for their particular situation. So, if that helps, I've always found that to be a pretty good way to get the client into it. You take little bites before you do the full plunge.
Yeah. By the way, an hour invested for this type of benefit is reasonable.
Yeah.
Yeah, it's reasonable.
Yeah.
Awesome. Thank you, Mr. Bloom.
And I was going to throw one thing in there. Is why my hand was up. So not only does the money not sit in a bank in Puerto Rico, we have people that want to understand this. It's a U.S. custodian. There's also no counterparty risk to these assets, and that these are bankruptcy remote accounts. So we aren't doing anything to go bankrupt, but even in that triple black swan event, these monies are protected and ultimately would be able to go back to the owner of the option contract.
Awesome. Awesome. Good stuff. Thanks, John. All right. Any other questions?
I just like to offer, if you do want some of the resources, just reach out to myself, John Bloom, John Chung on the call, Carter Sims. We can get you whatever resources you want. A lot of times, it's always good to go through a presentation like this with the business owner. I went through it pretty quick today, but we can spend as much time with them going through the intricacies and the nuances of the program. But there's a lot of tax benefits and wealth accumulation and exit strategies in this program. And oh, by the way, the business gets insurance
Yeah,
along
right.
with it.
Yeah, lest we forget, the
Yeah,
business gets insurance. Okay, I think we have one more question before we
sure.
wrap it up. Ed, fire away, man.
Does this product seem to address service companies more than manufacturing companies?
No, I mean, you just hit two of the two big proponents in the largest uh, employer group is in the medical world. Physicians, physicians and practices, ambulatory surgeries, places like that. Construction, manufacturing, service.
Right?
They're all right in there, right? So, I don't think either one of those favors the other, more so than the other, but, yeah.
I'd throw in there a little bit on that. Manufacturing companies in particular typically have concentration risks in their supply chain, whether
Yeah.
it's contracts, customers, suppliers. That's usually where we see the business owners start to really perk up is that they realize, oh wow, I can insure against some of these concentration liabilities that I have today. So manufacturing clients are great clients, candidly.
Matter of fact, we're gonna be in Chicago tomorrow presenting to a bunch of manufacturing companies.
Awesome. And that's a great point, John, and I hadn't thought of that. Because a lot of people forget that suppliers, you distribute suppliers and distribution risk are huge in manufacturing.
Yeah, and we see other types of concentration risks, candidly, in any business. I mean, a lot of these could be a key contract or a key customer. They don't have to have a physical supply chain to have these concentration risks. It's just very easy to identify these typically in manufacturing.
Yeah, and what's interesting, we're seeing an uptick as far as policy type, the reputational brand,
Mhm.
um, because of the onslaught of social media and anything that you can put out there on the internet and things, people's brand. I'll give you an example. We had a doctor in Northern California. He was a dermatology practice, and had a thriving practice. He fired an employee. She went out on social media, put all this bad information out on him, most of which was false. But he had to hire a company, and it hurt his practice financially. And he had to hire a company to help rebrand that. All that was covered with his brand and reputational policy. Um, and you know, we had a company number of years ago who Verizon was their biggest client, and they lost them out of their control. So don't think that these risks aren't real, and
Yeah.
they're real risks that the business owner, like I said, lose sleep at night. Yeah, we got another question. I thought I saw, or no,
I do not see another.
no, maybe it was in the
Um,
chat.
yeah, don't know. Compliments on the recording, etc. And I'm gonna I'll wrap it up and give you a chance to wrap it up yourself. First, by saying thank you very much. Really appreciate you sharing this program. I'm terrifically excited about it, and we are going to follow this up with we're going to have a podcast, a conversation, and there'll be other opportunities to learn more about different facets of this program. When we talk about creating predictable profits and cash flow and sustainable growth, every strategy should include the worst case, providing for the worst case scenarios. And Madison helps with that. Those of you who are CEXPs out there and getting involved in owner-based planning, you will recognize, there's an entire article to be written here about how Madison helps with non-traditional paths to underwrite some of these ownership risks. Which
Yeah,
is
and think of it this way: the Madison policies pick up where the traditional insurance leaves off.
100%. 100%. Okay, guys, we're 1 minute ahead of schedule. I think the questions I'm getting thank yous in the chat stream.
Thank you.
So,
Yeah,
Mark, thank you very much. Mark, John, Anya, and Carter. I think that's the whole team that's here today. Oh,
yeah.
and here. Thank you, guys, and we will talk again soon. It's a
We'll
real
see you in
pleasure.
October.
Yes, 100%. And thank you very much for your sponsorship.
You bet.
We're
Looking forward to
excited
it.
to work with you.
Yeah. Okay. All right.
Thank you.
George.
Perfect. Thanks.
Talk soon.